Hello everyone, welcome to our Egyptian online seminar group. First, keep thumbs up. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming to you Professor Roman Chychyla. Roman is an associate professor of accounting at the Miami Herbert Business School. His research explores the determinants and consequences of firm choice regarding the style, structure, content, and non-quantitative aspect of their communications with stakeholders, as well as the integrations of technology in accounting. His research has been published in top-ranking journals in accounting, management, and information system. Now we will start our seminar with dear Professor Roman Churchill.
Mohamed, thank you so much for the introduction. I really appreciate you doing this series, and it has been, long running. Had a really good speakers here. A lot of interesting research being done. So I'm happy to be part of the series. Thank you for doing this, and welcome to everyone who were able to join, this seminar. And thank you so much for coming. And actually, I'm really looking forward to your comments. All right, so today I will present, this working paper that is co-authored with John Barrios, Christina Bochkai, and Sundaresh Ramnes. And the paper is called Imitation or Information, Strategic Mimicry in Earnings Calls. And it's essentially kind of what we're trying to do in this paper. We examine how firms mimic peer disclosures in earnings calls and the implications of this behavior. And before we start, let me quickly go over the the outline of the presentation, right? So I'll start with introduction, just kind of try to explain the setting and kind of some sort of intuition what we're trying to do here. Then I'll go over the research questions and give a little bit more detailed explanation, why we think we want to do specifically, this sort of analysis and predictions. Then I'll talk about our data, our empirical design, and how we create measure similarity between firms, how we validate this. Then I'll go over the results and discuss some additional analysis and robustness tests we have in the paper, and also some of the ongoing work we have right now, which is not right now included in the current version of the study. And finally, I will conclude. And by the way, at any time during the presentation, if you have questions, please jump in, or any suggestions. Again, we are actually very actively working on this paper right now. So any of your feedback would be greatly appreciated. All right, so let me kind of start with explaining what we're trying to do in this paper, right? So we examine the communication in earnings conference calls. And as you know, earnings conference calls is like this major channel of communication where managers, have this opportunity to discuss their financial performance, to talk about their future plans, their strategies, try to somewhat cater to investors and address what their needs. And also, there'll be this Q&A session where they would, speak with analysts and answer this question. And these are very important events because they typically follow the earnings press release, or they follow, or, the same day when there are earnings press releases, that's when, you have these earnings calls. In fact, if you were to look at the disclosures, right, so these generate on average the highest market reaction throughout the year for firms. So because the importance of the earnings calls, and they have been extensively studied in the literature, and not only they are important, but they're also very different from your traditional financial reports, because in financial reports they're more formal, right? So they are have a lot of jargon. They are also very much sanitized by the staff and lawyers, and unlike your traditional financial reports, earnings calls are, the spoken language, kind of very flexible. So there've been a lot of research on, how exactly managers communicate. So in the past, people would look at things like, linguistic tone and style, or complexity and readability, or, the sequencing of the messaging. And so there've been a lot of papers that have specifically examined communications and its determinants, and also, what will be the consequences of, of the communication in these earnings calls, right? And what we do, we do something a little bit different that has not been really much examined in the literature, right? So we kind of start with this fact that companies do not have these earnings calls in isolation. Because what happens is that, when typically have earnings calls, you hold earnings calls, there were peers that also did the same thing before you, that held their own earnings calls. And you as a manager, you can actually observe your peers' earnings calls and what they have disclosed, and also how the market reacts to that. So as I said, this is kind of our starting point in the paper, that you as a manager, you're aware of what your peers are disclosing in their earnings calls, and then perhaps you can strategically adjust to that. And this kind of brings us to the kind of broad research question. So we're trying to understand, do companies learn, right? Do companies pay attention and learn from their peers' earnings calls? And, do they, and the reaction to the earnings calls, and do they strategically, adjust the narratives for that, right? And, we have these kind of 3 more specific research questions, and I will explain, the intention and our thinking behind these, research questions in a while, but I think they're also very intuitive, right? So, the question number 1 we have is like, do companies try to mimic some of the language from their peers, whose earnings calls were, well received by investors, right? And then we want to see, what do investors think? How do investors react to these, similar language in earnings conference calls? And finally, we want to see whether, this similarity, this mimicry, right, that companies may engage in, whether this is a signal about their kind of higher quality. If I copy in a more successful firm, is it because, I'm a higher quality just to that firm? Or is it just some sort of like a cheap talk? I'm just trying to, gain a favor from investors. So that's kind of our research questions. And let me kind of explain the intuition why, why we think that peers may try to mimic earnings call disclosures. And once again, if you have, any questions, any suggestions, please, feel free to just jump in and, and ask a question or give a suggestion. So, but going back to this, right? So, there are certain reasons, right? So if you just look at anecdotally what firms do, right? They would often try, there are these kind of common trends or themes that are of interest to investors, and they try to respond to them. For example, that we have this boom of AI, and everybody would talk about AI. Right before we had that analytics, everybody talked about analytics or ESG, so they would talk about ESG issues. In fact, one of the co-authors, Christina Bachkaya, so she also, works as the academic advisor for ISSB at the IFRS Foundation, and she would ask companies, right, firms, so in your voluntary ESG disclosures, well, how do you choose what to exactly communicate? And they would say, so the most common answers to that was, one is, we just try to ask investors what they want to hear. And B, we learn from our peers. We kind of look what our, peers do, and we learn from them. So that's kind of the anecdotal evidence. But then, we also have academic theoretical literature that would also support, some of this behavior, this mimicking behavior. There are these papers like Banerjee 1992 and Bikhchandani, Hirschleifer, and Welch 1992 as well, so about the same time, and they kind of have sort of the kind of similar argument. And the argument is that, if you have a firm and then you observe the choices of other firms, you may try to copy them. And the reason why you would copy them, because, when they make their choices, they reveal some private information that you may not have. And although your private information may suggest to do something otherwise, you still think there is some private information in the signals of your peers, so you may try to mimic them, to copy them, right? There is also this paper by Scharfstein and Stein, 1990. And that paper kind of takes a little bit different argument. So what they argue in this paper is that, you have managers, and managers have these career concerns. And managers are very sensitive to their reputation and how they perceive, right, by the, let's say, board of directors and by the market. So oftentimes they may try to copy decisions, perhaps disclosure decisions of their peers, because, in the event of some bad outcome in the future, right, they won't be singled out as being somewhat incompetent or of low quality. Yes, I think we have a question from Sarah.
Yes, thank you so much for presenting your paper. Could you hear me clearly?
Can you a little bit speak up a little bit more?
Okay, so now is it good?
Yes,
Yeah,
fantastic.
thank you so much for presenting your paper. It seems very interesting. I have a quick question. When you say what managers choose to say in the in the conference calls, you mentioned two reasons. They say what the investor want to know, and then the second one, mimicking the peers. How you distangle between these two channels in your research?
Yes, it's an excellent question, right? So it's a little bit later on in research design, right? So obviously, right? So if you have firms in the same industry and have the same, size and performance, they're very similar, there will be something that, they'll be similar in their language as well, right? Because, they're subject to the same kind of trends in the industry, subject to the same interests, right? So you would have that, and maybe, in some sense, maybe not, it's not really optional for them not to discuss that, right? And I guess what we're trying to do, we're trying to adjust for that by, including various fixed effects, right? So we will have, industry fixed effects, year fixed effects, quarter fixed effects. We would also have the firm fixed effects, and even later in our analysis, when we look at the kind of the, we would compare company A to company B disclosure, we would even include the company A, company B, like a pair fixed effect, right? So plus, we will also control for other firm characteristics, hopefully doing that. In fact, this is a very good question. A little bit later, I will show you on the graph that, when you have, firms in the same industry, they are significantly more similar than when you look at firms from different industries, right? So empirically, we're trying to do that somehow, right? And then when we include the, when we include the firms in our analysis, we do require them to be the same industry and the same performance. So then you counterfactual, right? Also companies in the same industries, and we still see variation there. So now that additional variation in the similarity between calls, that's what we interpret as, this kind of mimicking, right? To trying to maybe copy some of the messaging or styling from, from the peers. And well, I hope that somewhat answered your question. All right. So I guess moving on. So that, first part of the literature on that would again support mimicking is kind of so-called rational herding or cascading literature, right? So there is other literature, but it's mostly kind of from organizational behavioral literature, right? And so there's this paper by Image and Powell. So they argue that, as an industry, right, you belong as a firm in the industry belong to a certain group, right? And there are certain, norms and standards and maybe some certain ways of communication that companies try to copy just to, to have this sort of like belonging to this group, right? So have this some sort of legitimacy, so belong to this group. So that's kind of another reason why firms may try to copy, their peers. All right. Next slide. So oh, by the way, one thing I a little bit forgot to mention, right? That this mimicking is particularly silent according to the theory when you have this kind of high uncertainty. And kind of what we hypothesize is that, firms, when they, during the disclosures, they don't know exactly how market will react to the disclosures, right? So there is this kind of uncertainty in the markets, right? And because of this uncertainty, right, they may want to copy some of the narratives of the more successful peers. And by successful peers, we mean the peers that, that received more positive market reaction to their earnings calls, right? So we kind of predict that, right? That basically the firms will try to copy the language of their successful peers. That's our one prediction. We also think that, our second set of predictions is related to the investors, right? We think that investors will react to this mimicking. So they will probably, see this, that if I use a similar messaging as my successful peers, they may interpret this as a signal of higher quality, and they may respond to this positively, right? To this sort of messaging. And in the paper, we also have this simple model based on this Bayesian game theoretic framework. And in this model, right, so we kind of have firms, and firms try to maximize their value. I guess, I would say they market value of the company, right? And, they have a choice whether to try to mimic peers or not. And depending on the cost here, and when we talk about the cost can be something like again, reputational or credibility costs, or maybe perhaps some future penalties, right, for a firm. So depending on the cost, if the cost is very high, we arrive at this separating equilibrium. So under separating equilibrium, right, so we have that, and that's what we have here, signal hypothesis. So under the separating equilibrium, we have that, firms that, try to engage this mimicking do so because they want, again, signal they higher quality. Because, otherwise, if they were to do this just to, strategically, right, the cost would be too high, and, it's not worth it. But then, if the cost is somewhat low, right, or negligible or zero, we arrive at this pooling equilibrium. So under the pooling equilibrium, all firms, right, regarding how well they do, so the rational choice for them would be to do mimicking. So then they will be all pursued, hopefully better by their peers, because if you use some unique language, that may be actually penalized by investors, right? And under this framework, we would expect that that mimicking does not indicate somehow better quality firms, right? So we won't see better performance in the future. So under signaling hypothesis, we expect firms, to use mimicking as a signaling device, and we would empirically observe the better performance in the future. Another chip-talk hypothesis, right? We won't see that, right? So that's kind of our two competing hypotheses here that we tested in the paper. And kind of one thing I just also want to mention here, because I think it's actually quite important, is that we have these two hypotheses, and we do test them in the paper, which one kind of will work, which one dominates, right? But as most of the air-covered research, we do look at the average effects, in the sense that we believe that most likely we have two things going on, right? We have both signaling and chip-talk hypothesis going on, and this will be very much depend, on specific industry or a firm or information environment, how easy it is, to check the credibility of the company's disclosure, how many analysts look at this firm, so like things like that, right? So we believe there is actually a variation in this kind of cost of of this mimicking strategy. And in fact, that's probably what also gives us variation in our empirical tests, right? That's why not all companies choose to mimic, or not all companies choose to mimic, to signal the better quality. But what we kind of examine this paper, kind of what happens in the average, right? Which one dominates in the kind of the population of firms that we examine, right? Okay. So in our empirical analysis, we kind of take this three-step approach. So we do three things. Three types of tests. I'm sorry. So in the first type of test, we kind of calculate this pairwise similarity between earnings goals, and we want to see whether companies try to be more similar to the peers whose earnings goals were well received by investors, whose kind of earnings goals generated more positive market reaction. All right. So in second set of tests, we want to see whether how market reacts to this mimicking in earnings conference calls, and so we kind of do this market reaction kind of test. And finally, in the third set of tests, we want to look at the future performance and also future investments, right? We want to see whether this mimicking, again, does it indicate higher or maybe not higher future performance. All right, that's our kind of empirical design. And an important part of the paper, and in fact, maybe we don't describe it, we don't spend that much time in the paper right now on that, but that's a critical part of the paper is the methodology, right? Because if you think about it's a very complex problem in some sense. We want to kind of measure similarity between the firms and in spoken language, and these are different firms, and that becomes very challenging. And the reason why it becomes very challenging is that, you and I, we can talk about the same thing, or we can present the same research, right, with authors, or, do something, communicate, teach the same class, right? But we will probably use different words for that. We will use different styles, we'll spend different time on that. So we can say the same thing, but in many ways. And that's like always a difficulty with the language, right? And if you were to look at the kind of this traditional NLP, right, natural language processing techniques, They typically things like cosine similarity, where you have these, bag of words. You just kind of count the words and, create set of words and see kind of what is the overlap between usage of words, right? These may not work very well, right? Because, depending on how exactly how you frame the, your message, right? You may use very different words. Okay, so in this paper, we do rely on the kind of this latest and greatest AI technology, right? So we use large language models for that. And I think that's also kind of one of the innovations in the papers, in particular in accounting research, right? So what we do, we use this family of models. They call it sentence transformers. They're also called as BERT, or simply embedding models. So what they do, you can take a text, can be a sentence, can be a paragraph, it can be actually a whole text, depending on how granular you want to go. So you can take text and then you convert it to this numeric vector. And the idea is we have two pieces of text, A and B, and you convert them to these vectors, numerical vectors, right? So if A and B are very similar, the distance between vectors is also very close, right? If the A and B talk about like very different things, totally unrelated, then you would see that these vectors are very far from each other, right? So the distance between them is very high, right? So that's kind of what we use in this paper. And this is, as I said, it's kind of somewhat newer technology a little bit, right? Because traditionally, I think we are also using accounting to these word embeddings, right? You will like take a word in a sentence and embed it, right? So you have this word to vec, you have these BERT models, but unlike word, this one actually takes the whole text, whole sentence, or a piece of text, right? A paragraph, for example, and you can convert it to this numeric vector. All right, so we use this technology for, and I will give you an example how it exactly works. So we use the technology, this family of sentence transformers models, for two reasons. One is, when we take the whole big earnings calls, we would like kind of to find these kind of the key messages that the company communicates, right? And we use that to find the kind of semantically similar piece of text within the earnings conference call. And the other reason, one of the main reasons we use it, is because once we have earnings calls of two different companies, we use kind of the same technique to calculate similarity, the distance between them, the messaging, all right, that they do. All right, so let me show you an example. So how it looks like, right? So this is actually from our data. So we have two companies, and in one company basically says, and this is about like 3 sentences or 2 sentences. They say that, look, we expect to be profitable despite this pressure from the fuel prices going up. We will actually do well in the future. All right. So if you look at the second piece of text, right, then you'll see that we have more sentences there. They also have some numbers and things like this, but the message is also very, very similar, the key messages, that even during these times of higher oil prices, we'll still be profitable, right? And we are encouraged by our results, right? So in some sense, there's a lot of similarity between these two texts. And so our measure of semantic similarities has these two pieces of text are 76% similar. So if you were to use your traditional cosine similarity bag of words approach for these two texts, you will have only about 20% similarity. So they will say, well, this is actually a very different piece of text, right? So this is, the beauty of using these embedding models. In fact, one thing I forgot to mention about the models, so we use these Alibaba Group has these open source embedding models. That's what we use, GT large 1.5, and these work particularly well in the in the financial domain, financial context, because typically we are kind of maybe more used to OpenAI products, but OpenAI product embedding models are somewhat kind of older and do not perform as well, right? So these are kind of more higher accuracy models, right? That's what we use. All right. So, and then, as I mentioned before, kind of what we try to do in this paper, we take the earnings call and we try to find these distinct messages there, right? So, for example, this can be some topics or ideas, or kind of think about like bullet points. For example, you have a manager, and manager, makes first starting with introductory remarks, then move on to discussing the financial performance, then talk about maybe some investments, talk about some, new products, climate-related issues, and so on. So you're trying to find kind of these distinct messages in the, within the earnings calls. So here, what we do, we do this. We borrow this idea from from these generative large language models, this idea of retrieval, right? Retrieval of text, where you would like to provide some context for the models. So the idea is kind of to take the piece of text and, divide it into what we call chunks. And we use this technique called semantic chunking. And like very simply, what semantic chunking do, we have two sentences, sentence I, sentence J. You calculate their embeddings for sentence I, sentence J, the numeric vectors that capture the semantic meaning of these sentences. And then you kind of see how close they are. If you see that, that they are close, great. If you see that they're very far away, so most likely, the man just moved to a different topic, different idea. Then you kind of, you create a break there. So think about like you have a text and you kind of create, certain breakpoints. And these breakpoints determine your different messages in text. So that's what how we do this. All right. So I think we have about from 12 to 18 chunks in in earnings calls, something like that. So that's how many distinct topics or ideas you have from the managers. And what we do, we only consider the introductory remarks in earnings conference calls. So when you have earnings conference calls, you have this introduction part, and then you have the Q&A part. And we really want to see kind of what managers are trying to do, right? Maybe not prompted by analysts, right? So that's why we look only at the introductory part. So we take introduction of the earnings calls, use this technique, right? And these embedding models, these transformers models, to create these chunks, these distinct messages in the introduction of the earnings call. And then for these chunks, we calculate the vector embeddings, right? So we try to capture exactly what they say numerically, right? And then when you have a company A, company B, so we have set of chunks for company A, set of chunks for company B. We look at all possible pairs, similarity between all possible pairs between these chunks. And we keep only the ones where the similarity is more than 50%. So at least, discuss somewhat similar topics, somewhat similar issues. And then our measure is the average pairwise similarity of these chunks, right? So we kind of, look at all the possible pairs of disclosure messages that you have in earnings calls between two companies. We keep only the ones that are similar, and then we look at the average similarity between the remaining ones. That is sort of, our methodology part. And I should have said, it does take a lot of computational resources, right? And that's why, and I have these two pictures, I forgot to comment on them. So these are actually our servers that we built with multiple GPUs, like newer one, older one, and we run all of these on these, for several hours on these machines. But we were very happy with how actually the methodology works. All right. So let me kind of so one of the things when especially when you try to introduce some of the new methods, and in particular in NLP, right, in textual analysis, is that it is very important to validate the measure, right? So and we do this validation of our similarity measure, which we also use as mimicking measure, if you will, right? And we do this basically by in several ways, right? So the idea is that if companies are more similar, right, with the same industry, for example, you would expect to have more similar, more similarity between, the disclosures, right? And that's what you can observe in this graph, right? So first we kind of look at all possible, for each year and quarter, we calculate all pairwise similarities between firms' earnings calls, and we define some to be have high similarity if they are in the top quartile of the distribution. So if you were to look at the the overall similarity, right, as the overall percentage of firms who have high similarity, on average it's something from 20 to 30%, because we use quartiles. That's why we have that, right? But then if you were just to look at the focus only on the firms within the same industry, you would see that, well, the percentage of firms in the same industry with high similarity is significantly more. It's between 60 and 70%, right? And this kind of gives us some confidence that, the measure kind of works well. In fact, what we do later, we'll a little bit kind of zoom into this higher chart here, where you have the same industry. This line here in the same industry, right? So if you were to look within the same industry, we also expect, firms that are more similar. And one of the biggest determinants of similarity between firms would be the size. And firms who had, similar performance during this quarter, measured by the abnormal earnings. So we expect these firms also to be a little bit more similar in their message, right? What they say, and that's also what we find, right? So we have these two lines. One is the green line, one is the dashed blue line, and so this is for the same size and performance firms. And you can see that similarity is higher when we have companies of different size or different performance. Okay. In fact, and I would just want to underscore this several times. Later in the test, we do look at the firms within the same industry, same performance, and we do control for size. Right, because these are important determinants of the similarity. All right. So speaking of the data and speaking of the sample and earnings call, so we get transcripts. Earnings call. Yes, sorry, I had a question.
Yes, please.
Yes,
So
thank you.
I have a quick question here. So just to make sure I understand, so you look at the peer firm, which got the highest market reaction, and then you compare the conference calls of other focal firm, right?
Yes, not necessarily market reaction. I will kind of go to this. Well, okay, let me discuss this right now. So what we do is, and you can see this from the graph, so we look at what we call a focal company. That's our, let's say, company of interest. And the focal company is any company that is not the first in the quarter, in the industry to have an earnings call. So we look at the focal company, and then we have these peers that go before that company. So we have peer 1, peer 2, and so on. And we observe the earnings calls of their peers, and we also observe how the market reacts to the peers, right? We have this buy and hold normal return within 2 days of the earnings call. So that would be our kind of proxy for the market reaction. So we think that you would expect to have higher similarity, right, of the focal company to peers where this market reaction is higher, and lower similarities to the firms where this market reaction is lower. All right, that's kind of our first test and our hypothesis.
So is it like, did you what is the average time difference between these earning calls of the peer and the focal firm? Did you check the time difference? Because if it's like smaller, like the days is not maybe a smaller time of period of time, it can work in both ways. So the focal firm maybe will not have time to look at the conference calls by their peers.
Yes.
Or in the same time, it's still in a few days of the conference call, so they still have the same trends, and they will talk about the same topics.
Yes, thank you for the question. We do look at that, and we do control for this distance. So I think the average, and it's on the paper, is about, I would say, 5 days or something like this. Right, so that will be the average distance. I think we use the log, but if you take like this, exponentiate, I think it's 2 exponentiate to so it'll be about something like 5, maybe 6. That's the average. But we do control for that. I'll tell you more than that. That's a very good question, because actually sequence and timing is very important, and we do several things with timing. And for this particular matter, we also, and this is one of our robustness tests, we do different windows, right? So first our main test unrestricted, right? We don't kind of restrict, how far is your peer. And then we take a smaller window, I think like 30 months, then 10 days, a week. And in fact, when you kind of take these, when you restrict it to smaller windows, right? Whether you only look at the peers within, let's say, a week or so, we get stronger results, right? We get results much stronger than that. So we try different things. And our main results are robust to that, to the distance. But yeah, thank you. Excellent question.
Thank you. I have another question, if you don't mind.
Please go ahead. Allow questions.
Okay, when you check the similarity, you only focus on the introduction, right? Not Q&A.
That is correct.
And then later you mentioned we will look at the similarity based on the market reaction of peers. But what I believe that the market reaction usually is driven by the Q&A part of conference call, not to the introduction. Usually the introduction is already prepared and, management know what they are saying, but for Q&A, it pay more attention from investors. This is usually new information. So, yeah, so I'm not sure.
Yeah, for now we didn't want to do that just because we feel like, we have managers have less control over that, our Q&A. So we haven't considered that, but, it's a good suggestion. We might, right? No, I still do think that, there is some, reaction to the introductory part as well, right? At least we would expect.
Yeah.
Actually, that's what we see from the research, right? If you were to look at, there's all this research on like linguistic tone, right?
Yeah.
And the tone of the management in introduction does matter, right, for the market reaction, right? So it's not necessarily the only analyst Q&A, right? You have a bunch of papers showing that the language in the introduction part also matters a lot.
Okay, perfect. Thank you for clarifying. Thank you.
Yeah, thank you. All right. Oh, let me go back. And actually, I'll go back to the more on the timing because the timing is super important. Yes. So we get these transcripts, right? Going back to the data, we get the transcripts, and that's somewhat limits our sample, right? That's, we have reliably transcripts from 2007 and onward. And then, we need to have information because we want to account for various firms' characteristics, right? For information environment, and be able to measure the market reaction, right? So we merge our kind of transcript data with Comparstat, IBIS, and CRISP. Okay. So then we get about 450,000 pairwise observations, and these are the ones that already kind of mentioned the industry and year, quarter, and earnings news. So that's kind of all possible pairs of firms, but they have to be within the same industry, same quarter, and have a similar performance, right? As measured by the abnormal earnings. And then finally, our overall sample is about 51,000 of, firm year quarter observations. And going back to the timing here. So, one of the concerns is, well, not only, how close you are to the, peers or far you are from the peers, right? But also do firms strategically choose timing, right? Based on their performance, right? And that also might affect language. So this is actually one of the newest additions to the paper that we have right now, and we have several tests on that as well, try to, account for that. So what you will see, so these are the firms, that's their kind of distribution of the announcement timing, kind of how late or how early they go in the sequence of earnings presentation kind of season, right, for the given quarter, given industry. And what you will see that firms, and so these are you have here 5 lines, and they correspond to different performance quantiles, right? So we have Q1, that basically firms that have the lowest performance measured by earnings surprise. Then we have Q5. These are firms with the highest performance measured by earnings surprise. So what you will see is that the firms who do extremely well and extremely badly, right? So in terms of earnings, they tend to go much later, right? Or later at least, right? So you can see these 2 lines are below. So they kind of most of the probability or the timing mass, what they do, right, is constrained on the right side of the graph, right? So they do seem to go somewhat later, and that's a concern for us for sure, right? And that's kind of another reason why what we do, when we look at the pairs of companies, we do want to have companies with the same performance, right, within the same quantile, kind of. So we look at these lines separately, analyze them separately, and compare them to each other separately. But it is a concern, right? And again, it kind of also tells us that first we have to be aware of timing. B, it's very important to control for the firm characteristics, industry, as well as performance. All right. So that's why have several times that we have look at the peers in the same earnings, unexpected earnings quantile. Okay, so let me kind of walk you through the results. Let's see, it's that time, perfect. Right, so in our first set of results, we just want to see, do we observe this mimic to begin with, right? Is it like phenomenon or not? right? So our dependent variable in these next test is this peer similarity, right? So we have company A, company B, and we look at the similarity between, between the messaging of these firms. And we do see when we regress the similarity on, firm characteristics, and we regress on, on the peer information, such as so we have focal company, we compare to the peer company. So again, peer company goes before the focal company. So the focal company has to observe the peer company. So we do see that the focal company have high similarity to peers with higher market reaction, with higher return, right? This 2-day window return. And this is true for, for this text that is both, have forward-looking statements. So this is this second column, FLS, and also for text that doesn't have like this most past-oriented text that does not have forward-looking statements, right? So they kind of try to mimic, copy both kind of messaging, right, on the timing. And we do see that, especially when you look at the FLS, right? We have this one of our measures, this whether you have in text, where you have some of these buzz topics. So we generate for every year, we generate, what again are these kind of common things, buzz topics discussed, like, AI or, climate risk and things like that, right? So we do see that, especially with respect to the forward-looking statements, that's also what the focal company is trying to mimic. And also the tone, the linguistic tone, whether it's positive or negative, seems to matter a lot. So the focal companies are more likely to copy peers with more positive or more optimistic messaging, okay? And one thing I also would like to emphasize here, we do have the firm fixed effects. So, I don't see like a lot of firm controls because we do have firm fixed effects, and also year-quarter fixed effects, right? And that's kind of our main results. Oh, let me go back here. So in the next set of tests, we just try to do different specification of kind of similar tests. So in this one, we try, instead of just looking at the peer return, which is a continuous variable, we try to decompose it into, let's say, positive and negative, right? So first we have this dummy variable, which is 1 if a firm has a positive return, peer firm has a positive return, and 0 otherwise. So we also see that basically that firms try to mimic some of the language from peers that have this positive return. And we kind of decompose it further. So we decompose the return into extremely negative, moderately positive, and extremely positive, depending where the market reaction, where the abnormal return falls at, right? We have like these different buckets. And in this column, and I think it's important to emphasize here, so we don't see here extremely negative return, because it will be the intercept. So these coefficients are with respect to firms that had peers that have had extremely negative returns. So you would see that you do have more similarity to firms that have negative returns compared to the one that have extremely negative returns. You even have greater similarity to firms that have positive returns, right? Overall, and I think like what we learned from this specification, right, is not only that firms are trying to mimic some of the language from their peers that were successful, right, had good positive market reaction. They're actually also trying to avoid the messaging and the language from the peers so that have kind of this extremely bad negative market reaction. All right, so I think that's kind of what's interesting about this test. All right, and then our last specification is, now we change the we convert our continuous variable similarity to the dummy variable. So we create this high similarity and low similarity outcome. So the high similarity is if you look at the pair of similarity, and it falls within at the top quartile of the similarity distribution. And the low similarity is 1 if pair of similarity falls in the bottom quartile of the distribution, right? So, and kind of I guess like here results also very similar, right? So we see that companies again more similar to the firms that perform well, to the positive kind of return firms, peers, let's put it this way, and they're really trying to avoid, right? They're really trying to avoid the ones that did not do that well, right? At least were not very well received by the investors, Okay. So overall, like if we were to look at all these tests, right, that would again, someone suggest that we see that. And then going again back to the timing, right? So we're still kind of concerned about the timing. That maybe you have firms strategically choosing to go later or earlier, and that will correlate with performance, and it will also correlate, how with the mimicking strategies, things like that. So what we do, we follow this paper by Noce on the Verge, 2021. And in this paper, they distinguish between pattern and non-pattern earnings calls. So the pattern earnings calls are the ones that kind of happen consecutively at the same time. For example, you can have a firm like Microsoft, and they would always have earnings call on the second day of a given week. All right. So, and if you do this for the last couple of years, right, then we would assume that so we would call these earnings calls pattern earnings calls, and and you would at least hope that they are less subject to this kind of strategic choice of timing, right? So you probably wouldn't observe, this would be like some sort of endogenous, choice of timing here. And so we look at we have a sample with pattern firms, pattern calls, and sample with with no pattern earnings calls, and we see that actually for both samples our results still hold, right? We still do observe this kind of mimicking behavior in both of our samples. All right. So, and this kind of leads us, after kind of this establishing that firms do engage in this mimicking, strategic mimicking, right? This kind of leads us to our next set of tests. We want to see how market reacts to this mimicking and whether this mimicking is indicative of better future performance. So for these tests, what we do right now, we we want to go from the pair level analysis to the firm level analysis. And our current specification in the paper, but we also work on some alternative specification, but our current specification in the paper is that we kind of have this simple 1 or 0 switch, dummy variable for a given firm year quarter, right? So if a company copies at least one, have high similarity with at least one peer with a positive return, this is B1. If firm does not try to copy peers with positive return, this will be 0. Okay, so again, so this dummy variable will indicate whether a company engaged in this mimicking trying to copy successful peers. So what we find is that, if you look at these columns 1 and 2, what we find is that there is a stronger market reaction, all right, to these firms. So if you look at the first 2 days, cumulative normal return, the first 2 days, including the day of the earnings call, you would see that market reacts positively, right? So investors do perceive, do like this maybe sort of messaging, they think, well, here's the company, and this company is more similar to these previous companies, they might be doing well, right? So we do have greater market reaction. In fact, I think what's very interesting here, if you were to look at what happens later, so then we look at what happens days between 3 and 30, like up to a month, after this initial market reaction, we don't see a reversal. Right, we do have some negative coefficients, but the magnitude is low and they're not statistically significant, so we don't observe this kind of reversal in that. So again, this is some kind of telling us that market reacts to this, mimicking positively, right? And then the natural question is, well, okay, so if the market reacts positively, do we observe better future performance for these firms? And the answer is no. Right, so what we do, we again take we take all the firms, we look at the firms, and we look at their future performance in the next quarter, 2 quarters after that, and up to a year. Right, so we look at future quarters, and we don't actually see that these firms who engage in mimicking somehow doing better in the future. In fact, we have this additional test, and this is the one at the table below, and in this additional test, we look at this reduced sample. So the reduced sample is the sample where we include the firms that mimic, that engage in mimicking, and also we include the firms that they do mimic, right? So we exclude everybody else. So we have firms that mimic successful peers, and they're successful peers that they actually mimic, that they have kind of the highest similarity, right, to these firms. And when you look at that, we see that the future performance of firms who mimic is lower than the future performance of firms that they mimic. Right, so it's very interesting. So we kind of almost see that this negative performance compared to the successful firms, the successful peers. All right. And we also do an additional test because it is possible that you have a successful firm that was well received, and let's say they talk about AI and they talk about the future investments in AI, and then you have a company that's trying to copy some of this language, right? That we will kind of also do something similar. So we want to see whether the companies who mimic, whether they try to also so I guess like the concern here that maybe this better quality is unrealized immediately in the earnings. It will take some time. They're just making these strategic investments that will pay off later, right, in the future. So here we also examine their investment decisions. I want to see whether the firms will mimic, whether they're trying to, also do more investments. And we do find some very weak evidence for that. It's kind of the first column, but this is when we include all the firms, where we include reduced sample, just like we had before, where we only include firms who mimic and the firms who they mimic, right? So we include everybody else. So in that case, we don't see that. So we don't see that somehow they try to increase their future investments. Yes, I think there's a question.
Hi, Professor. Can I raise a question right now?
Of course, yes, please.
I'm a PhD student from India. I really found your study really interesting. So I have a couple of questions. Am I audible to you?
Yeah. Yes, very good. I can hear you very well. Please go ahead.
So I have a couple of questions. So in one of the previous results, you showed the results between forward-looking statements and non-forward-looking statements, right?
Yes.
So, but in the earlier presentation, you didn't actually tell us like how did you classify those sentences to FLS and non-FLS?
Oh,
So
yes.
in the primary section, you stated that you use SBERT. So it is a common for classification, right? So I'm curious to know, how did you classify to FLS? Or did you simply use SBERT, or did you use any other models for that?
Yes. Yes. Thank you. Thank you for the question. Actually, that's actually important here, right? Because like when you think about like FLS, how you classify this, right? So traditionally, right, people would, well, I think it was like this Muslet paper, right, where you would kind of look for some specific, you look for some specific keywords about the future, and you classify this as the forward-looking or not. So what we did like, again, modern approach, right? There's this paper by Juan et al. Where they look at how can we use bird models to classify sentences. And what they do, they develop a model for the forward-looking information as well as for the tone. So we use these BERT algorithms that are kind of much more accurate to do that. So we do this both for FLS and for tone. So basically, if we have the chunk of text and we have at least one sentence that talks about the future, according to that BERT model, then we will classify this as a forward-looking information, forward-looking chunk. And with tone, right, so we calculate it on the sentence level basis, and again, that's based on the Juan et al. Methodology. So that's also based on the BERT model. In fact, when we use that version of the tone, it loads much stronger, like this better, more accurate version of the tone loads much stronger in our test, in our in our regression analysis.
So
We try
is
like
it like
I'm sorry. Go ahead.
So is it the fine-tuned version of FinBERT, or is
Yeah,
it
so
something else?
so we did this like so if you go to the Hugging Face, you will see that the authors made it publicly available. The Hugging Face is this kind of portal for all these LLM models. You can download them, so you have them there, and that's what we used. And as I said, kind of they work really well, better than your traditional kind of keyword approach, right? So because for tone we also use Locker-McDonald approach on this one, and this one, it's even stronger, right? So that's a more accurate way to measure the tone of the sentence. Yeah.
Okay. So
yes,
I'm recently also exploring these aspects. So when I looked at your method section, you stated that the earnings calls were taken from the capital IQ, right?
That is correct.
So,
Yeah.
yeah, so and you have around, I think, 55,000 plus observations. So did you individually download those PDFs, or is there any automatic
Oh,
way,
no, no, no,
automation
no,
that
no,
you
no. Yeah. So what Capital Q does, and we do this through words, right? So there is like a database. There's like a SQL database where you have multiple tables, and there's a table about called information, who are the speakers, what the date, and then they also have a text in this PostgreSQL SQL database. So that's what we use. It's not PDFs. That's already kind of nicely formatted data, textual data in the database. You just have to get it, merge everything together, and then run it through your models. But it's yeah.
Then I would like to know, how much time did you take from, let's say, taking this text to converting into the variable? So how much time did
Yeah.
it actually take, and how much resources does it involve?
Yeah, a lot. I'll be honest, right? A lot. And I think if you know exactly what you want to do, right, and that's like the difficulty with research. You do research, and it takes time to figure out exactly, okay, so how do you do this? What is the best way? And you test it, and you look at some results, right, until you kind of figure out the kind of most accurate measurement approach. So that's what takes most of the time. And then if you have powerful machines, and you can either have them yourself, or you can even rent them. Nowadays, all these cloud machines that will charge you a dollar or a couple of dollars for an hour, right? So I guess calculating all these embeddings, well, the semantic chunking took a lot of time, like maybe like 12 hours, and the other one also took 8 hours. Well, depending, right, on your hardware, right? So it's it's doable. It's all doable. You do need to have good hardware for that, good GPU in particular, right? But it's all doable. Yeah, it's not very bad.
Yeah, so I was running the environmental BERT on Google Colab on an annual report. So it actually took 4 to 5 minutes. So on a single annual report. So I was curious about the time and the resources. Like, how did you optimize these things? Did you go for Google Pro or something like that?
Yes. No, we have we have our local servers that we build specifically actually for this kind of AI computations, right? So that's the two machines. One has 2 GPUs, the other one now has 4 GPUs, right? So they're very good at it. The Google Colab does give you some GPU power. It's somewhat limited, but remember, we also, and let me emphasize again, we also didn't use a traditional BERT model here, except for FLS and tone. We didn't use the BERT. We used SBERT, sentence BERT. So the difference is, when you use the BERT model, you have a text, it will calculate embedding for every word in your sentence. This one takes your sentence or your paragraph, chunk in our case, and calculates the embedding for the whole thing, for the whole sentence. Just one vector, one numeric vector for your whole text, not like for individual words. So this one, will be kind of in this sense also faster and more memory efficient and more storage efficient. And you will kind of capture what this meaning of the whole sentence, not individual words, right? So when you look at these specific like words, like the classic examples would be, you have a financial bank versus you have a river bank, right? So that's where this vector word embedding is very good, because you can with BERT you can see different semantic meanings in these sentences. But that's not what we're striving for. We're striving for to capture the overall message, right? So in a given text or a piece of text. So that's why we use this sentence transformers model. So they are faster and more efficient than your word embeddings.
Yeah. So another thing, like when I looked at the way you have done this work, so I was thinking, can we classify the sentences to particular topic, then look at its imitative power? Let's say climate. Okay, are these films talking similarly about climate, especially
Yes.
in the introductory section or descriptive sections? Then, like, is it possible, right?
Yes, it is, right? And in fact, speaking of that, thank you so much. This is a very good question, because we're actually working on it right now. That's our kind of priority, right? We now a little bit talk about like what we're doing right now. If we, as I said, we are kind of actually revising this. So one of the things is we do want to look at the topics, right? I think like the main difficulty here is identifying the topics that you actually want to classify it into, right? Because you can like 2, 3, 10 topics you have to choose, right? Ideally, you would choose specific topics, right? Here to talk about investment, here to talk about performance, here to talk about climate, right? or like we were giving suggestions that make it simple, look at like financial performance was not financial performance, right? Topics. And the way, probably the best way to do this would be maybe to start with some Gen AI. You would have something like GPT-5 or Claude or something, right? To do, like at least create a sample where it will go through and analyze this. And then you can also train your own BERT model to do for classification. So yes. Yeah, so nowadays, like that's like, the golden age, right, for text processing, for textual analysis, because with all the tools we have nowadays and, with this technology, and there's a lot of investments going there, we can do a lot, right? You just have to be kind of creative, but yes, this is very much doable.
Thank you so much, Professor.
We're
Thank you
trying to
so
do
much.
that. Yeah, thank you.
Thank you so much.
All right, thank you for the question. Let me go back. Yeah, so I guess actually I did go through all of the main results. So in our additional results, which is also something new we have just done recently, we try to address some of these issues that, again, but with the timing, we try to address the issues that maybe, you have firms and, and they try to copy these other firms because they're also very similar in their business operations, things like that. So we did like a similar sort of analysis as we do with earnings calls, but this time we look at the latest available 10K of a company before the earnings call, right? And we look at the business description. Right, there's like a paper by Holberg et al., right? So where they show that business description, you can kind of create your own industry based on that, based similarity in business description. It works very well. And again, we took the semantic embedding approach here, where we would take all our pairs, we calculate also the similarity between business descriptions. That's somewhat reduced our sample, and we include this as the kind of covariate, as a control variable in our regression analysis, and we still have the results, right? The results don't change. So you can have companies that that kind of have different businesses, do different things, but they still seem to be engaged in mimicry. Yes, Michael.
Hey, Roman. Good to see you. This is Michael Tan from FIU.
Yes. I know, recognized. Yes.
Okay. A very interesting paper. I just have a question about the learning, the mimicking successful earnings conference call. My question is, do you distinguish between the companies with good earnings surprise versus with good conference calls?
Yes. So right now what we are doing, right, we are only comparing companies within the same quantile of earnings surprise. So when we look at the peers, right, let me go back. When we look at the peers, right, so the peers have to be in the same earnings quantile. Just to kind of avoid this, because we do observe, right, from our previous analysis, that firms within the same performance kind of are also more similar, and we don't want that, right? We at least at this stage, we do not want to the performance to be this distinguishing driver of similarity, right? So we look at with kind of similar performance. Having said that, right, what we haven't done and we were thinking of doing is maybe looking at whether this effect is stronger from depending on where you stand on your performance, right?
Right.
And that's going to be kind of discussed right now. But yeah, performance is definitely a big driver of similarity, and right now we're trying to to look at companies within the same performance, so not to kind of have this issue.
Right. And then I think related to that, I'm just curious whether you find the similarity to be higher for higher performing firms pairs.
Yeah, so that's kind of what we're trying to do right now, right? So we don't have this in the paper right now. We haven't done the stats, but yeah, that's what we're trying to see.
Right. I think the reason for that is because I think the research shows when things are good, then good news are kind of more alike. Whereas if things are bad, then every company kind of have more of a different problems. So I think the similarity might correlate with the performance.
It might, right? And I guess with our measure, right, if you look at the firms, let's say the highest performance decile, right, that again what we capture currently in our main test would not be driven by the performance, right? So, but it would be nice to know if there's some interactive effects, right? Is similarity is even higher or even lower, depending on the group performance, right? You're looking at. Yeah.
Okay, great. Thank you.
you so much. Yes, Sarah, it seems like you have a question.
Yeah, I forgot to mention I'm from Florida Atlantic University, student in job market.
Yes, I
So
know. I've seen your papers. Yeah.
yeah, so commenting on the similar performance. So if they have a similar performance, they are more likely to be similar, like the similarity is higher. But then in your additional analysis, you find that the performance is not similar, right?
Oh, no,
The firm with a high similarity doesn't have a good performance in the future. So it seems like they have a similar performance before mimicking and then they divert after that.
Well, I guess sort of. Well, first of all, we do use some different measures of performance. We use like any surprise. That's what we mean by performance. During the earnings call, and then we look at earnings, right? Future earnings. But yeah, like a firm goes through different things, right? So, sometimes they're doing well, sometimes they're not doing well, and the whole kind of idea when you were to look at, because I work a lot of textual analysis, right? The whole idea why people even want to examine the spoken communication or written communication is that you have numbers, right? But numbers just part of the story. That's why you have this communication text to give the context, right? So for example, the managers may say, you know what, we had less good performance, but we expect even stronger performance in the future. So things like that, right? And that's why I guess we find that there's things like linguistic tone, right? If you have a kind of more optimistic messaging during conference calls, it will be also indicative of high performance in the future, right? So in addition to these hard numbers, what we measure, right, through accounting means, right, there are also this additional information that the managers have, and they will try maybe communicate some of it or hint some of it in the earnings calls. Right.
I also notice in the graph you provide the similarity drop in the COVID and in the financial crisis, but it also dropped in 2016. No, the other one, for similar, the next graph. Yes.
Yeah.
So it's dropped in the COVID 2016. Is there a reason for 2016 period or?
Yes, it's kind of a good question, right? So that's something we sort of really haven't examined it much in the paper. And honestly, some of these drops and downs can be also due to how we so here we look at the percentage of high similarity. And that's also maybe to do how we define high similarity, because we look at the whole possible distribution, and then look at the the quantiles, like whether it's high or not. And what kind of may happen that during this, let's say like COVID, right, for example, that firms just maybe have more unique messaging, right, or they will they may talk about something more specific to their business, right? And then why do we see that drop here? Well, we don't know. I'll be honest, right? So it's something that we haven't really examined that well.
Okay, thank you.
Thank you. Yes, Yachin.
Oh, hi, this is Yachin. So I'm wondering, maybe you're gonna cover this later, but I'm start to wondering how the financial analysts actually react to those similarities. Like more specific, for example, I'm a financial analyst. I listen to Walmart. I listen to Target so many times. They use the focal company gonna use exactly the same language. So do I have a more accurate forecast for my focal company? Because it's the same information, like based on what I'm hearing, on my understanding of the similarities that you're talking about. We are talking about the profit all the time, use exactly the same language. We're gonna use exactly the same excuse why our earnings are not perform so well or perform exactly the same.
Yeah.
So, like going forward, what about the analysts?
Yes. No, this is good question, right? So far we haven't looked at analysts, we just look at the investors. But yes, makes sense, right? To see basically how the analysts, right, revise their earning expectation after that. We haven't looked at that.
Yeah, I think it's also related to your investor reaction as well, right? If the
Yes,
similar
it'll be
language,
similar.
right. But if your similarity actually reduce those information asymmetries, it's gonna affect the market as well. So, well, it's just
Right. Yeah, so
something
exactly.
interesting to look at.
My guess would be that since we do observe market reaction, and if you believe that market does listen to analysts, that we will find somewhat similar results with analysts, right? But we haven't done
It
that.
can also go the other way. If I hear the same story again and again, I don't have new information. I don't know if my forecast gonna be more accurate,
Yeah.
or it's just, you know, the information is not, there's no information to revise either my recommendations or those forecasts. So
Yeah.
it's gonna be interesting to find out those results.
No, that's a good point, right? So if you were to look at the theory, right, of this information, this rational hardening cascades, right? So it's that would actually, that the information quality would deteriorate, right? Because you would maybe express less of your private signal and try to copy some of these themes. So that basically it's not not the best thing to happen. Yes. Thank you.
Yes.
That's a very good, very good point.
Thank you.
We haven't done, but we'll think about this, I promise. Yes. Thank you. All right. So let's see if I have some time. That's good. Let me a little bit go back to the robustness test. So as I said, basically we do control for business similarity. We still have the results, right? And we also do a bunch of different other tests, right? So we we try different specification of the variables. We look at different deciles, right? We include, and this is actually a very, very powerful test. We include both the firm and peer fixed effects, like together, like a pair fixed effect, right, for two of the companies. We try estimating regressions on smaller samples independently, see results hold they do. Then we try this placebo test where we randomly assign, performance, market reaction to firms, like positive or negative, and the result then we don't see the results, right? So placebo test really do not hold. We also try to randomly assign the similarity the companies, if again somehow it's random, and it also we don't observe the results, right? Right now we are actually somewhat revising our measures. So as I like, we're doing this on the chunk level, which is great, but also we found that chunks sometimes a little bit less consistent how it works. The semantic chunk with some firms sometimes have like a large piece of text, sometimes have a small piece of text as semantic chunks, which is again maybe good but maybe not that great. So in addition to that, we also now doing analysis where we look at the sentence level. So we have all sentences by a company, and we have sentences by the other company. So we try and for each sentence calculate the maximum similarity to the sentence in the other company, and then take the average. And it kind of also works very well, right? So that measure also works very good. I think it's kind of a little bit maybe easier to understand sentence levels than chunk. We also tried different algorithms, right? So we started we started this project about maybe like 9 months ago, started kind of actively working on the empirics and everything. And we started with this GTE 1.5 by Alibaba group, right? That model used to be like one of the best models. 10 months later, it's like 2 generations behind what's like the best, because all these AI models developing very quickly. So we just tried, Qwen 3, 8 billion parameters, like the best performing model as of June, right? And actually it also worked very well, right? So our results didn't change with the newest, more accurate model, and also with kind of model AI models was different architecture. So that seems to hold. And we also right now working on the topics as well, as mentioned before. So again, so I guess in conclusions, right? So what we try to do in this paper, we try to examine, this interaction between earnings goals, right? And whether, managers learn something from their peers, peer disclosures in earnings goals. And we do observe that, we have this mimicking behavior where, managers try to copy some of the language and style from the peers that generated positive market reaction, right, to their earnings goals. Right, and this appears to be more in line, at least on average, right? This to be more in line with these Chychyla hypotheses that they try to copy this and market reacts positively, but we don't actually see that being reflected in future performance. So this is not a signal of higher quality, but perhaps it's an opportunistic way to get more favorable market reaction from investors. And well, I guess that's it. If you guys have any questions, please go ahead. Or, if you would like to email me and, with, some questions or suggestions, we would really, really appreciate that. As I said, we are very much in the process of revising everything. So we will, much appreciate any kind of help, any suggestions you can give us. But, otherwise, thank you very much.
Yeah, thank
Yes,
you.
cool. I have a couple of questions. Fantastic.
Yeah.
Let's go.
Should
Sarah?
I
I got a
start?
couple of- Yes, please.
Yeah, one more question. So, how you identify the peers?
How we identify peers, right?
Yeah.
So we look at, peers within the same quarter. Oh, one thing I forgot to mention. So we look at only the companies with the fiscal year end in December 31. And
Yeah.
the reason why, because we didn't want to have the seasonality effects going on, right? So then we look at the firms with December 31, and then we look at the firms who had earnings call in a given quarter. So for each company, each focal company, the peers are firms within the same industry and with the same performance, the same time, same year quarter, same industry, and same unexpected earnings quantile.
Have you tried like TNIC as a robustness check because they have more similarity regarding to their products, prescriptions, descriptions,
Oh,
or there is
that-
another paper published, I believe, by Jennifer Tucker and Rust. They use AI also to identify peers.
Oh, yes, I guess like for us peers, right? When we say peers, like we just look at the industry. But yeah, that's a good
Okay.
point. Right? We can try to look at
Okay.
some of the alternative. But it'll be
Okay,
very
thanks.
computationally extensive, difficult.
Yeah, I
like,
know it's a lot of
explain
work.
everything.
It's
Yeah,
just
that's a
too
lot
much.
of
Yeah. Good luck with it.
calculations. Yeah, but thank you. Yeah.
Thank you.
Thank you. Yes.
Hi, Professor. I have one more question rather than clarification. So I also, as I told earlier, I was also testing on these textual analysis. So I also did run on chunks and as well as on sentences. So do you think that your results may differ when you change from chunks to sentences? Like what I saw is that when I look at the chunks, the classification I did on topic classification, so the classification is more vague, and you are, I think you're capturing the semantic similarity, right? I think the meaning of those sentences, like we could, if we simply say
Yes.
like that. So I think there is a so what, based on my observation, is that there is a chance of changing the results, or you may be able to better capture if you go for sentences rather than chunks. Is that so? This is my clarification question.
Oh, yeah. No, I understand. Yeah, so we do now right now do a sense level analysis in addition to chunks, right? And I'm not sure if it's better, right, or worse. Again, like our results kind of very similar, right, with both of them. So I don't think like one is like some particularly stronger or worse, right? I would say about the same. But then we haven't done the topics yet. I would actually expect topics to be maybe a little bit better on chunks. The reason why, with chunks, you just have more coherent message. Maybe it's easier to understand, what the topic is about. But, for topics, what we do, I don't think we will kind of do word embeddings, sentence embeddings there. We will just, initially, I think the plan for us would be to take a text, let's say a chunk, or it can be sentence. Let's say it's text. And we will use some of the generative AI models where we will ask, oh, here's the text sentence. Let's say, does it talk about financial performance, yes or no? Right? And we'll kind of give you an output. You can have a JSON output, kind of yes or no, true or false, right? So probably we'll do something like this. It's either we will run the whole sample using Gen AI, or maybe run a large sample and then train a model that will imitate the thinking of the these large generative large language models, and try to classify sentences. So that's everything. But I actually don't know, right? So we haven't tested it yet. But my guess,
Okay.
right? My
So,
intuition would be that probably chunking would be probably a little bit better though, right? Because these you probably can better gauge what is the topic there. But then also we haven't done this yet, so I don't know. We're kind of working on this, but
I actually had the opposite
yes.
idea, because like when I also took the extract of those sentences, means those chunks, those chunks were stopping in between a sentence. Let's say you have 2-3 lines and stopping in between. So let us compare two sentences where it starts from one full stop to another full stop. So what I found is that, okay, then I was doing the topic classification. So I was thinking I didn't do much. Then I'm planning to do it. But so what I feel is that, okay, if it's stopping in between, there are chances of classification means blur in the classification because it's stopping in between. So this is my primary understanding. So I was trying to get a more clearer.
I understand. So what we do, we don't do. So we do a little bit more sophisticated chunking, right? So like many times when they use chunking for large language models, they would say, let's look at the 500 characters. We'll take 500 characters and we do like not 500
Right,
characters, but maybe some overlap with 50 or 100. We don't do that. We do the semantic
Mhm.
chunk, which is actually much more slower and more computation intensive. And what this does, we do a break at sentence level. We look at one sentence, the other sentence. If they are similar, we don't break. If we see a sentence and another sentence are very different from each other, that's where we break. All right. So we will break at the sentence level. So that's called semantic chunking, but it is somewhat expensive because you have to calculate embedding. So you just don't take the 500 character size chunks. And chunk can be a different size, smaller and bigger, depending again how the text breaks semantically. Right, but kind of how much time management spend on particular unique message, So that's what we do.
Yeah. Thank you so much, Professor. Thank you so much.
No, thank you.
Are there another questions? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Roman, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much, everyone joining us today, and thank you very much for taking the time to present to us today. It has been appreciated. Thank you, dear Professor Roman.
Again, Mohamed, thank you very much for the invitation and this opportunity. It's been great, and thank you everybody for joining and your questions. They're fantastic. And we'll try to do our best to address all your questions and comments. And if you have any other thoughts, please let us know. Thank you.
And I hope to see you soon in Egypt. You are very, very welcome.
Thank you. We'll try to do that. Thank you. Likewise, whenever you're in Miami, please let us know.
Thank you.
Thank you.
Bye.